Since the 7th of October 2024, if somebody tricks you into transferring money to them in Britain, your bank has to give it back. Not might, has to. Up to £85,000, normally within 5 working days, under a binding direction you cannot be made to opt out of, and the bank cannot decline to follow. No other country in the world does this. When it was proposed, the objections were serious, and they came from serious people. If banks are always going to refund you, why would anyone be careful? If a refund is guaranteed, what stops a fraudster and a supposed victim splitting the proceeds? And what happens to a small payments firm that gets targeted, has to reimburse everybody, and does not have a large bank's balance sheet behind it? Those are not silly arguments. Every one of them describes a real mechanism. In July of this year, an independent evaluation for the regulator reported on the first year of the scheme. Scam losses covered by the rules fell by around £73 million a year. Nearly 35,000 fewer scams took place. The predicted exodus of firms did not happen. So it worked. And the interesting part, the part that makes this worth 20 minutes, is that it did not work for the reason anybody argued about. The refunds are not what reduced the fraud. Something else in the design did, and almost nobody was discussing it at the time. So let me tell you where we are going. First, what this kind of fraud actually is, and why it was uniquely difficult to protect anyone from. Then, what the rule says, and the one detail buried in it that turned out to matter most. Then, what the evaluation found, including a genuine contradiction in the numbers that I am going to walk through rather than pick a side on. And finally, what all of it says about how you get an industry to solve a problem it did not create. Let's start with the fraud itself. It is called authorized push payment fraud, which is an ugly phrase that is doing precise work. Take it apart. A push payment is one where you send money out rather than someone taking it. A bank transfer is a push payment. Paying by card is not. With a card, the merchant pulls the money from you. Authorized means you approved it, you logged in, you typed the account number, you confirmed it. As far as the bank's systems are concerned, the legitimate customer instructed a legitimate transfer and everything about the request is correct. That is the whole problem in one word. For decades, fraud protection was built around unauthorized transactions. Somebody steals your card, uses your details, gets into your account. The defining feature is that you did not do it. And because you did not do it, the bank can see the transaction is anomalous, and the law is clear that you are not liable. Authorized push payment fraud sidesteps all of that. There is nothing anomalous to detect, because you really did make the payment. You just made it for a reason that was a lie. And the lies are extremely good. Somebody phones, claiming to be from your bank's fraud team, tells you your account is compromised, and walks you through moving your money to a safe account. There is no safe account. Somebody impersonates your solicitor during a house purchase and sends new bank details. Somebody you have been talking to online for 4 months, who you believe you were in a relationship with, has an emergency. An investment platform with a professional website and a plausible return. The scale is substantial. UK Finance's annual fraud report put losses from this category at £576.4 million, with investment fraud specifically up 40%. Now, before the new rules, what happened to you if this occurred? Broadly, it depended on your bank. There was a voluntary code, some banks signed up, others did not. Some reimbursed generously, some reluctantly, some barely at all. And a very common outcome was that a victim was told they had authorised the payment themselves and should have been more careful, which, depending on the sophistication of the scam and the vulnerability of the person, could be anything from a fair assessment to a grotesque one. So the same fraud on the same day produced completely different outcomes depending on which bank happened to hold your current account. And you had no way of knowing that when you opened it. Now here is the deeper problem, and it is the one that makes this a genuinely hard policy question rather than an obvious one. Think about where a scam payment actually goes. Your bank sends it, but it arrives somewhere, in an account at another bank, usually opened for exactly this purpose, or belonging to somebody recruited to let their account be used. Those are called mule accounts, and they are the essential infrastructure of this entire crime. Without somewhere for the money to land, the scam does not work. So there are two institutions involved. The one that sent the money, which had a customer being deceived, and the one that received it, which had an account being used to launder proceeds. Under the old arrangement, all the pressure was on the sending bank. It was the one facing the complaint, the ombudsman, the reputational damage, and any reimbursement. The receiving bank faced essentially nothing. Its involvement was invisible to the victim, who never knew which institution had accepted the money. And that is a genuine misallocation, because think about who is better placed to stop it. The sending bank sees a customer making a payment that looks, in every technical respect, legitimate. It can warn them, and it does, and people ignore warnings because the fraudster has already told them the bank will try to stop them. The receiving bank sees something much more diagnostic. An account opened 3 weeks ago with minimal activity, suddenly receiving 11 transfers from strangers, which are emptied within minutes. That is not subtle. That is a pattern a competent system flags immediately. The institution best able to detect the crime had no financial reason to bother, because the cost of failing to detect it fell on somebody else entirely. That is the situation the new rules walked into. So, what do they actually say? From the 7th of October 2024, under a specific direction from the payment systems regulator, reimbursement became mandatory for authorised push payment fraud over the faster payment system, which covers the overwhelming majority of real-time transfers in Britain. The maximum is £85,000 per claim. Firms can choose to pay more, but not less. The target is 5 working days. There are limits, and they matter. It covers faster payments, not chaps, which is the system typically used for the very largest transfers, such as house purchases. It does not cover moving money between your own accounts at the same bank. And there is an exception where a customer has been grossly negligent, which is a deliberately high bar rather than a general get-out. But here is the provision that changed the outcome. And it is not the reimbursement at all. The cost is split 50-50 between the sending firm and the receiving firm. That single sentence is, I think, the entire reason this worked. Because it means that a bank whose systems allow mule accounts to operate now pays for half of every scam that lands in one. Not as a fine, not as a regulatory penalty after an investigation, automatically on every claim as a direct consequence of having accepted the money. The institution best placed to detect the crime is now the institution that pays for failing to. And the evaluation is explicit that this is what did the work. Its finding is that the 50-50 split incentivised receiving banks to tackle mule accounts, and that this is what drove the reduction in fraud. Not victims being made whole. That is the part everybody argued about, and it is the humane and correct thing to do, but it is not what reduced the number of scams. What reduced the number of scams was making somebody care about the other end of the transfer. If you are finding this useful, that is what this channel is. Every figure from a named source, working out why things cost what they cost, and who ends up paying. Subscribing is how you get the next one. Now let me go through what the evaluation found and then the contradiction, because I would rather show you the messy version than a tidy one. The evaluation was carried out by Frontier Economics, independently for the regulator. Its headline findings on the first year. Authorised push payment fraud losses covered by the rules fell by around 21%, which it puts at roughly £73 million a year. The number of scams fell by nearly 35,000. On reimbursement, the picture is dramatic. Before the rules, the proportion of stolen funds returned sat around 68%. In the first 3 months after implementation, it was 86%, with 84% of claims resolved inside 5 working days. Across the first 15 months, the regulator reported that 89% of in-scope losses were reimbursed, and the evaluation reports 97% of in-scope claims paid. And the disasters did not arrive. No exodus of firms from the market. The moral hazard that dominated the argument beforehand did not show up in the data. Other countries are now looking at the model. So, the contradiction. UK Finance's annual fraud report says authorised push payment losses were £576.4 million and describes that as a 19% increase. The evaluation says losses fell by £73 million a year. Losses up 19%. Losses down 73 million. Both published within weeks of each other, both from credible bodies. Now, the tempting move here is to pick the one that suits the story. I am not going to, because the reconciliation is more interesting than either number. They are measuring different things. The evaluation covers only fraud in scope of the rules, faster payments, within the cap. UK Finance's figure covers all authorised push payment fraud, including categories outside the scheme. They also count differently. The evaluation measures on the basis of when a scam occurred. UK Finance counts on the basis of when a claim was made. Those produce different totals for the same events, and the divergence is deliberate rather than an error. And crucially, the evaluation excludes slow-to-report investment scams, which are exactly the category that grew fastest, up 40%, and which make up much of the highest value fraud. Somebody defrauded by a fake investment platform often does not realise for months. So the honest reading is that both can be true. Fraud within the scheme's scope fell. Fraud overall, including large categories outside it, rose. The 73 million figure is described by the evaluation itself as a flaw on a partial picture, rather than a settled verdict. I think that caution is the most useful thing in the whole document, and it is the bit that did not make the headlines. And it points at something structural, which is the second thing worth understanding here. The rules apply to faster payments. They do not apply to chaps, which means that the single largest transfer most people ever make, the money for a house, sits outside the protection, and conveyancing fraud, where somebody impersonates your solicitor and sends new account details, is among the most devastating scams there is. That is not an oversight nobody noticed. It is a known gap. The review currently running is not expected to extend the regime to other payment rails in this round. So we have a protection that covers the payments most people make and not the payment that would ruin them. Now, the review, because this is live rather than settled. The regime is being examined, with findings due across 2026 and 2027, and a consultation expected in December. 3 things are explicitly on the table. The £85,000 cap, the 50-50 split between sending and receiving firms, and the consumer caution exception, the evidential threshold for saying a victim was so careless that they should not be reimbursed. That third one is the difficult one. And I want to spend a moment on it because it is where a genuinely hard tension sits. If the threshold is too low, banks decline claims from people who were comprehensively deceived by professional criminals, and the protection becomes conditional in exactly the way it was designed not to be. If it is too high, there is no space at all for the rare case where somebody ignored every warning, or where a claim is not what it appears. There is no setting of that dial that produces the right answer in every case. It is a choice about which kind of error you would rather make. And the fact that the evaluation found the predicted moral hazard did not materialise is a reasonable argument for keeping the bar high, because the thing the exception was meant to guard against turned out to be smaller than expected. Meanwhile, the regulator that created all of this is being abolished. The Treasury confirmed in April that the payment systems regulator's functions will transfer to the Financial Conduct Authority, subject to legislation. So the reimbursement regime and the December consultation will pass to the FCA as that transfer completes. Which is worth sitting with. A regulator introduces the only mandatory scam reimbursement scheme in the world. An independent evaluation finds it worked, and the regulator is wound up and folded into a larger one. Not as punishment. The consolidation is a separate policy about simplifying the regulatory landscape, and it was in train regardless. But it does mean the body that will decide the future of this scheme is not the body that designed it. So what should you take from this? Practically 4 things, and they follow from the rules rather than from anything I think. If you are tricked into transferring money by bank transfer, you are very probably entitled to it back. Report it to your bank immediately. 97% of in-scope claims were paid, and the target is 5 working days. Second, the evaluation found victim awareness of the scheme remains low, which means people are being defrauded, assuming nothing can be done, and never claiming money they are owed. If that has happened to you or someone you know since October 2024, it is worth going back to. Third, the gap. If you are moving a very large sum, a house purchase, typically by chaps, the mandatory scheme may not cover it. That is the transaction to be most careful about, and the one where you should telephone your solicitor on a number you already had, not one from an email. And fourth, a scam is not a transfer that looks wrong. It is a transfer that looks completely right, made for a reason that is false. The question to ask is never whether the payment is correct, it is whether the story is. But the general principle is the thing I would actually take away, and it is not about fraud. For years, the debate about scams was about whether victims deserved their money back. That is a moral question, and it produced a moral argument, with two sides both convinced. The thing that reduced the fraud was not the answer to that question. It was a technical decision about liability allocation, that the receiving firm pays half. A sentence in a direction of no interest to anybody outside the payments industry, which quietly gave the institution that could see the crime a reason to look for it. That is how most of this actually works. The argument happens about the visible emotional question, and the outcome is determined by an accounting decision underneath it that almost nobody is discussing. Britain made banks refund scam victims, and the sky did not fall. But the sky was never the point. The point was that somebody, somewhere, finally had a reason to notice where the money was going.